join. Okay, I think we're good to go. Okay, so for today's class, we'll be looking at market structure. So we started market structure in last class, but I got a few feedback from few students that we really need to revisit the market structure. So I was thinking about how to best explain it so everybody can understand, or at least let's say 80% of people are carried along. So I think I'm going to go over the market structure again, right? I'll go over it. And if you have questions, please just note your questions down, right? And you can maybe towards the end of the class, or you can raise your hand during the class. And someone just let me know. If I don't notice your hand raised, then I can let you ask the question so that we can try. I always want the video not to be too long because I know people have the challenge of watching long videos. However, if you're serious to make money in this industry, you have to get used to watching long lessons and long videos. You have to get used to watching them because I can tell you, what I'm teaching is over the experience of watching over 1,000 hours of videos, and I'm not exaggerating, maybe more, over 1,000 hours of videos from different contents on YouTube and everything, just finding out missing pieces till I got what works, and I'm here to shorten your process. So please permit me, if the classes are up to an hour or 45 minutes, you just have to be patient to go and watch them over again. That's how you will understand it, right? Because principles and valid principles for success, they are very slippery. So you need to watch them over and over and over again so you can understand them, right? So let's get into the business of the day. If you can see my screen, I just want you to indicate so I know you all can see my screen well. Can you all see my screen?
Yes, sir, we can see your screen. I can.
Okay.
I can see your screen.
Oh,
Yes, I can see your screen.
okay. So we can start, right? So market structure. I did this diagram so I'll better explain, right? So from our previous class, I made you understand that market structure is based on the movement of the market, right? So we have like three primary ways the market moves, right? The market's either going upward, right, which is called uptrend, or the market is going downward, which is called downtrend, right? Or the market is moving sideways, which is called accumulation or consolidation, right? So we kind of like explained the three cycles of the market, which is accumulation, manipulation, and distribution. I explained from our last class that if you look at this candle under reference, if you look at this candle for a little bit, you see the way that this particular candle moves is, first of all, it has the open, right? The open for a bullish candle, the open is always under, right? The open, then it gives you the low. So the movement from the low back upwards is what creates what we call the shadow, which is the wick. If you remember the last class, you can go over the class on the on my YouTube channel at God of Indices, right? You have the long wick, then the body is what we call the body of the candle. This green part is what we call the distribution, which is the main movement of the day, right? Then you have the high, then you close a little below the high, right? So this wick here, based on the cycle of market movement, this wick here, the shadow here, the under shadow here is what we term as manipulation, because most times, 80% of the time, the candle will not just start and jump up. it must manipulate, right? It must manipulate, it must grab what we call money, it must grab liquidity, because there'll be players in the markets that their money will be used to push the market upwards based on the algorithm, right? That's the way the algorithm is programmed. So it has to manipulate, because so there can be momentum, so that there can be volatility in the market. Do we get that part? I'm just doing a recap of last class, right? So we understand better. So for every candle now, if you look at this candle, this particular bullish candle here, this is, let's take for instance, I explained the time frames for us, right? Let's take for instance, this one candle here represents a 15-minute chart, which is which is price action in 15 minutes, right? So the movement, this 15 minutes chart, if you go to a lower time frame, this is what you will find in this 15 minutes candle. You'll find that in creating the upward close of the candle, it created series of higher highs, higher lows, higher highs, higher lows before it closed up here. So the movement of the 15-minute candle, if you go to a lower time frame, to show you this kind of structure. That's why it's very important to know that every candle you see printed on every time frame is a representation of structure movement in the market. That's why you need to understand structure. So let's take, for instance, this particular candle here is the daily candle. Is a daily candle, right? So now in a day, you have multiple 4 hours candle, you have multiple 1 hour candles forming. So the same thing will repeat itself. You see series of structure. You see higher highs forming, higher lows, higher highs forming like this, right? This movement in that particular daily candle will show you structure, but if you go to the daily time frame, it will only show you one candle, right? I hope that's understood. Right, I think you can unmute your mic. Is it understood? Can I go further?
Yes, I understood, sir.
Please, sir, if you can throw a
Okay.
little more light.
Okay. Now, simply what I'm trying to explain is, now let's just take this high and look at this particular candle. Right now, my chart, the chart where I am is, let's look at this candle, right? So in our last class, I talked about different time frames, right? That in the forex market, there are different time frames you can trade, right? We have I said you can even have a 5 seconds chart to 1 minute to 3 minutes, 5 minutes. Like you can see on my screen, these are the charts that are shown on my screen here. Can you see my mouse cursor there? So this is a 1 minute chart, this is a 3 minute chart, this is 5 minute chart, this is 15 minutes, this is 30 minutes chart. I'm going to do a particular class that I'm going to just explain about this time frame and give a little bit explanation about TradingView, how to use the simple tools to get yourself started on TradingView for people that did not spend time to watch the videos that I recommended and I dropped on the channel for us to watch on knowing how to use TradingView. But you have these multiple time frames, right? So for every time frame, let's take for instance, if we are on the 5 minutes time frame, a full candle, either a bullish candle or a bearish candle, is 5 minutes. The duration of that candle is 5 minutes, right? So on the 5 minutes chart now, for a whole day, if you are looking at the 5 minutes chart, you see that there'll be multiple candles, right, to form a whole day, which is 24 hours, right? A day is 24 hours, so it's 24 hours of trading. So you have multiples of those five minutes candle. Let's take a simple example that we can understand the mathematics behind it or the arithmetic behind it. Let's say 1 hour time frame. If you come to the 1 hour time frame, a single candle formation is 1 hour of price action. So in the 1 hour time frame, for you to have a whole day of price action, you have 24 candlesticks printed. Do you get that part? you have 24 candlesticks printed, and these candlesticks can have different direction they are moving in, right? You can have a candle that will go candles closing up, then you have series of candles closing down. If it was a uptrend for that day, this is how it's going to be for that day. Series of candles will close up to give you up, then series of candles will close down. So this is exactly how it's going to be formed. That's why if you see from your assignment, you see you mark it like that. When you showed me the higher lows to higher highs, higher lows, higher highs, like that for upward movement. Then also for downtrends, you have series of, if it was a down close day, if the whole day was a bearish day, that means price was going downwards for that whole day. You have series of candles. You have bullish candles form upward, then bearish candles form downward, bullish candles upward, bearish candles will form downwards like this. Do we understand? Right? So this is for a bearish day. So now what I'm explaining, so you understand that every candle printing is a printing of structure. So if you see one candle printing, let's say one candle, 1 hour candle, if you go to 5 minutes, it will show you the structure of that 1 hour candle. Now, is it clearer right now? Is it clearer right now? Right? You can just chat, let me know, okay, or
Yes, sir. Yes, sir. It's clearer now.
okay, so we can progress now. So this is the main, I think with that backdrop and the recap of previous lesson, I think you can understand it better. So now I was thinking of a way for us to understand the rule that I set for market structure in the last class. So I drew out this diagram to better explain market structure, right? So this is basic market structure. If we have time, we'll go into advanced market structure. But for now, let's just make sure you get the basic market structure right? So now you can see this printing. Let's take this first diagram, for instance. Let's take this first diagram, right? So you can see exactly what I explained. Now, this is the movement of price. It moved higher high, it came down, higher low, it now went to another higher high. Do we understand? So that's the movement of price. Now, what is the rule for validating the higher low, which is this point? What is the rule for validating? The simple rule for validating the higher low is that the candle must trade below, because of bullish movement, and we're looking at bullish movement right now. So when we finish bullish movement, we're going to look at bearish movement, but for now we're looking at bullish movement, right? So for a bullish movement, for uptrend, the rule for you to validate an higher low, there are two basic rules. Number one rule is that the candle in question, the candle must trade below the candle that took out the previous candle's high. Now I call that candle, I call it, let's say for the purpose of this our class, I want to call it the important candle, right? So now what's the important candle? The important candle is that particular candle, the very candle in question that took out the previous candle's high for a bullish movement. Now, that candle needs to be traded below, right? So either by a candle closing below, it can either close a candle below like this, it can close below like this, or a wick trading below it like we have in the diagram here, right? So that important candle, which is the candle that has taken out the previous candle's high. This is the previous candle's high. This is the previous candle's high that was taken out. Can you see that high? That's the previous candle's high that was taken out. So this bullish candle took out that previous candle's high. Now it now became the candle under reference, which is our important candle. So for us to have a valid higher low, so it must be any candle, whether a bearish candle or a bullish candle, it doesn't matter. Let's take, for instance, this candle that took out this previous candles. Let's see. Let's say, for instance, this candle is also a bullish candle. It doesn't matter. It doesn't invalidate the rule. The rule states that the next candle that forms after the subsequent candles that form after the important candle must trade below the important candle's low and close upwards, right? So if you see in this case, I told you it could be a bullish candle, it could be a bearish candle, it doesn't matter. That's the rule to validate your higher low, right? That's the number one rule, right? Number one rule. Then number two rule, I don't know if I should write it, but maybe that will make you go and watch the video again so that you can take notes, but I'll repeat it again. The subsequent candle or candles must trade below the important candle's low for bullish movement. So it can either close below or a shadow trade below it and it continue moving upward. Like we can see in this case, we have this here. Now this validates this place, this point here as a valid higher low, right? As a valid higher low. So I think someone dropped a message. Okay, let me see. Okay, I should write it. Okay. Okay, I will. I just want you to understand it. Okay, so now this is rule A. I need a bigger space. Okay, let's do it up. The subsequent candle or candles must trade below the important candle. I already explained what important things. Important candles low and continue upward. That's rule 1, right? Oh, sorry. Okay, that's rule 1. So let's bring it here. And then break it. So important candle and okay, this is good, right? So we can all see it, right? So this rule A. So the subsequent candle or candles, which for this example here, the subsequent candle is the bearish candle, must trade below the important candle. Now, this is the important candle I tagged it. It must trade below the important candle's low. This is the important candle's low under here, right? Can we see it? This is the important candle's low. Let me use this marker. Can you see that's the low there? That's the important candle's low. Can you see? It traded. Oh, sorry. Okay. I wanted to mark it out, but you hope you understand. So it must trade below the important. This is the important candle's low. Can you see? If I draw a line to this side, can you see it traded below that low? Right? So subsequent candle or candle. So it can be 1, it can be 2 that will trade below this important candle. Then the other candles now continue upward, closing. I'm going to the second rule. Now, the second rule is that after trading below it, the second rule that the important candles high must be traded above and closed above, like we can find here now. So this is the important candles high. Let me write the rule 2. If I'm too fast, just slow me down a bit. So the rule 2 is that rule 1 met, right? So rule 1 is met. So rule 2 now states that we must close the high. Okay, candles. Let me just how am I going to put this? Price. Okay, then put price. So if I put price means candle. So price must trade and close above the important candle. So that's rule 2. Do we understand this point? Can I move forward? Can I progress? Hello,
Yes, sir.
guys, are you with me? So
Yes, you
you
can.
understand to that point, right? So I can progress. So now
Yes, sir.
the diagram
Yes, sir.
explains these two rules. Yeah, good, I get you. So the diagram explains these two rules, right? And this is why I say this is valid. Now, this is the rule of structuring your valid higher high. Higher low, sorry, higher low. Because of this rule was met, you see, the rule was met. Rule 1 was met by this kind of trading below. Rule 2 was met by it going and closing above. Let me take out this thing so we see it. Okay. By it going and closing above the high. Can you see? Can you see that this candle closed above the important candle's high? Now, that means rule 1 met, rule 2 met. So this is a valid higher low, thus giving you the next highest point, which is your higher high. Understood? Okay. Now, if we look at this, the second diagram too, if we look at the second diagram, it's the same rule. You can see this was the, okay, yes, this is the exception. This is the exception. Now, that's why I put the second diagram, because this is when you see the exception. Now, the exception to this rule is the case where the subsequent candles high are equal for bullish movement. Now you can see here the subsequent candle in the diagram 2. The subsequent candles high, they are equal. Can you see that? They are equal. So anytime the subsequent candles after the important candle is the same height, the high is equal. Now the next candle that will take importance will be the next candle after the subsequent candle, which in this case is the bearish candle. Please pardon my English. I'm just trying to simplify it as much as possible. I hope I'm simplifying it enough, right? So because the previous candle or the subsequent, sorry, because the subsequent candle is equal to the previous candle, which is our important candle, right? In this case, right? This is the important candle, right? Because they have equal height. Why? Because it's a bullish movement. So they have equal height. What does it mean? It means that the bearish candle has taken over precedence of being the important candle. So now because of this, the bearish candle now becomes what? The important candle. So now the important candle we are looking at is the bearish candle. So rule 1 and rule 2 will now apply for the bearish candle. Do we understand? Is that simple enough for us to understand? This is the only exception of this rule. When the subsequent candle is the same height, the high is the same as the important candle, then the subsequent candle will take the precedent and become the important candle for you to apply rule 1 and rule 2 to them. Do you understand? Now you see this also valid. If you understand, I'll progress. So if you don't get it, you can just chat me. So that's what it means. So now you see in the third diagram, oh, someone's okay. Jeremiah, you can unmute your mic and ask your question quickly.
Okay, so I wanted to ask, if the subsequent candle closes at the same high with its what's
Important
the word
candle.
now? Yes, but not okay. So when they close, what if they don't close, but they both what's the word now? The tiny needle end are on the same at some point. Does this rule still apply?
No, the rule applies for only the shadow. So
Okay.
if you have a case like this, you see a case where you see from in this diagram the bodies are the same with the shadow. But if you have a case where it's like this, the rule only applies to the shadow. Even if it's like this, the rule applies, right? The rule still applies because we are looking at the shadow, which is the wick. Even if the candle is like this, it still applies. Do you get the point? So
No,
it's the
no, no.
wick, the height of the high. That's why I say the important candles high. You remember in our previous class when we're looking at the anatomy of the candlestick, we named them now. This is the high now. This is the high. This is
Yes.
the close. This is the low. Yes. So it's the
Okay.
high.
Okay.
The,
Okay.
the,
Okay,
the
sir.
important is the high. Yes. So the
Okay.
rule applies
Okay.
for only the high, not the body or
Okay.
the
Not the
close.
close. Okay, sir. Okay, sir.
Yes.
Thank you, sir.
So that rule understood. Now, if you see this next diagram, now this we cannot. That's why I noticed I corrected a few people. I cannot remember, but I corrected somebody on this in when you send assignment where you saw candle traded like this. It didn't trade below the important candle, and the person still mark this point as higher low. And I said that in the next class you understand better. Now, I hope it's clear now. You see that this cannot be marked as a valid higher low. Why? Because despite the fact that there were two bearish candles that traded, but they didn't trade below. And if you see here, this candle, this high, the important candle's high is higher than the next candle. So we cannot, this rule does not apply to it. Do you understand?
Yes, sir.
Are we clear? So we can move forward, right? Okay. Someone raising their hands. I thought I saw someone raising their hands. Oh, okay. Let me see. Okay, I think we can proceed. I thought someone was raising their hands. Okay, we can proceed. So now understand this factor because it's getting deeper. And if you don't understand these basics, it might get confusing for you. So understand this. So it's safe that we can proceed, right? So now the next thing we're going to be looking at, I'm going to be explaining break of market structure, right? Then we'll go down to explain. We can enter. Let me see how many minutes have we spent. Okay, so let's explain this, right? Now I'll explain it, then we'll go to the chart, then I'll show you chart example from all I've explained from the start of this class. Now, in an upward trend, like we can see here, this is an upward trend. And for this case, this is a down trend. Price is going down, right? So in an upward trend, anytime the previous high, right, which was your higher high before, anytime the previous high is taken out, we call that break of market structure, right? So you see, this is what validates an upward trend, because in an upward trend you form higher highs, higher lows, and you'll be taking out the previous high. Why the lows always maintain like a trend line. Sorry, I don't want to teach you about trend line, but it's a retail analogy. You don't really need it, but I'm just trying to explain that the lows are aligned while the highs will be taken out. That's what I just want to explain to you. Please, sorry, I just remembered this. Please, if you want to get the best out of this class, right? Like what I'm teaching you is institutional price action, right? How to trade using the algorithmic trading style, right? So I'm not trading normal retail where you have chart patterns. That's why you see I'm not going to explain chart patterns. I know all that. That's what I started with that, and it elongated my journey. Why? Because it's not precise the way. Yes, there are people that trade normal retail chart patterns. They make money. It's because they have been able to have a very, 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 very good risk management and a very, 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 very good psychology. That's one of the ways you can make money well trading retail. Yes, like I said in the previous class, there are 1,001 ways to make money in this market, but I'm showing the more precise way. Easy if you understand this. This is what price does. It follows the algorithm, right? So if you had learned maybe previous retail concepts, trend line, trading, double top, double bottom, and head and shoulders, and all those things before, for you to get the best out of this class, is just unlearn that. Because if you try to merge this one. It will take you a longer time. I'm not saying it's not possible, but it will take you a longer time for you to synchronize this knowledge with your retail strategy. It's easier for you to just unlearn that one and just go with this one. Ilya, can you unmute your mic and ask your question?
I can't see the screen, sir.
Can any other person see the screen? If you can't see, I'm sure maybe it's your network. Can you guys see my screen?
All right.
Let me just know. So
Yes, I can see it.
Yes,
Yes,
I
we
can
can
see.
see.
Yes, I
okay, so Ilya, you just maybe go back and join again. Maybe your network. If you can't see my screen, it's probably your network.
All right.
Okay, I saw Sadia raising her hands. Okay, she's put her hands back down. So okay, so let's go further. Now, so in this movement, anytime the high for bullish movement, anytime the previous high is taken out and a candle closes above, right? Now we can explain this with this our diagram again. You see, keyword candle closures. The candle must close above the previous high, not a wick. So if you have a case like this, if you have a case where price action did this, let me give an explanation. Let me try to modify this diagram. If you have a case like this where candle action, price action did this. Let's see. Okay, so this was the previous candle. Then you have the wick. It just went above the high, but it didn't close above it. This is not a valid break of market structure. This is not valid. You must have candle closure. It must close above the previous candle high, right? As signified in our diagram. So for uptrend, you have this. For downtrend, you see that it closes below the previous lower low, right? So this is the lower low. This is lower high, lower low, lower high, lower low. So it closes anytime you have market goes below and closes below the previous lower low, you have a break of structure. What does it mean? It means that market is about to break its current structure. So it tells you that market is breaking structure to the downside. So market is going downside. So let's say we have a diagram like this. Let's say we have something like this. Market was previously going high like this. Like this. The market comes like this. Now, I'm going to explain this diagram. I'm going to explain this too. So let's pay attention. Now, this is what we call this. If you didn't understand advanced price action, you will call this break of structure, market structure. I'm going to explain the difference. You will call this break of market structure, right? This also, you will call this also break of market structure. Now, there are two ways for this class. Sometimes I'll be interchanging. It can be market structure shift or break of market structure. So the same thing. It's called in the terminology market structure shift. So this is the same as market structure shift. Where is it? Oh, okay. I think I don't have that. So this can also be market structure shift, which is also called MSS, right? Now, this is where I'm delving into advanced price action right now. So pay attention. I think I can delete this. If you're taking notes, you must have taken this. I can delete this so I make this obvious. I delete this too. Okay. So now we are going to advanced price action. Now, I just taught you basic market structure, higher highs, higher low. But you know, when you start trading, when you look at the chart, you see that it's not as simple as it seems. Because if it was that simple, then everybody will be a billionaire. Everybody will make money. There will be no losses in the market. It's not that simple, right? Because there are other concepts that comes into play that makes you understand, which are the concepts in advanced market structure, right? So we are going into advanced market structure now. Probably, most likely, I'm going to just give you a bit. Then in the next class, we'll conclude on advanced market structure because our time is fast spent. So this is advanced market structure. Now, this is how price moves. Price doesn't just move in a straight line. Like if it was in a straight line, every buyer will just position themselves in a higher low and buy and go up here. To be so easy and everybody will be billionaire, everybody will be happy. But it doesn't always happen like this in the marketplace, right? So now there's a concept of what we call liquidity. Liquidity, and we also call it inducement, this concept. Now, what is liquidity? Simply put, liquidity is money. That's what it means, right? People that are into finance, like you say the company is not liquid, or when a company files for bankruptcy, that means it's not liquid again. Or when you are talking about in economics, you're talking about the assets that can easily be liquid, easily be converted to money. So we can say liquidity is money, right? So it's money that drives the market. The algorithm uses money to drive the market, right? Now it uses players. Now, when players put orders into the market, either buying or selling, where their money is resting. Sometimes when you are buying, like I explained in our introductory classes, that Forex is the only business that you can predetermine your risks. So if you are buying, you have a predetermined risks where you want to know that, okay, take me out. If the trade is not going my direction, I'm ready to lose $100. I don't want to lose more than $100, right? So that your order now becomes liquidity in the market, right? So the market now targets your order, because if you are buying and you put your stop loss, let's call it a stop loss, it's called the stop order, right? Stop loss. We are going to explain that in detail when we get into the risk management part. But for the purpose of this class, just understand the stop loss is to stop your loss. It's simple as that. Is to stop your loss. You are saying that you don't want your loss to go more than this. So let's say, for instance, you are buying under this higher low, right? You are buying from this higher low. You now put your stop loss around this point, and in monetary terms, let's say the stop loss is, let's say, $200. It's $200. So once, if price comes down, like you see this movement here, you are buying and holding. This movement here has used your money, has taken out your stop loss. What does it mean? It means that if you are buying at this point, you are inversing your order. I don't know how am I going to explain it. Okay, you bought the price for it to go higher, but it didn't go high. So at this point, you are selling. So you bought higher, you are selling. No, you bought how do I explain this in simple terms? Okay, let me just explain it like this. At this point, your stop loss in money becomes money for another buyer that wants to buy at that price, because the price is lower, right? So you bought at a higher price, but price came down lower than the price you bought, thus bringing you in loss, right? So you said, okay, I don't want to lose more than $200, right? So now this your $200 now becomes the price, the money to engineer another person, another buyer in the market that decides to buy lower than you, right? For price to move higher. That is now called liquidity. So your money now has become money, liquidity in the market for price to be engineered upward, right? Now, I explained that to explain that in advanced market structure, price will always set liquidity points, right? Because the algorithm knows that simple retail traders just know higher high, higher low, higher high, higher low. They don't know much about advanced market structure. So when they are buying, they will put their stop losses orders under the higher lows. Their stop loss orders will always be under the higher low, thus making that place liquidity for the market. So before the market moves higher, it must come down for that liquidity. Now, it's based on this simple principle that you buy low and you sell high. So the algorithm works based on that principle of buying low and selling high. So the big players will flow with the algorithm because the big players don't want to buy at a higher price, right? So imagine I'm a hedge fund player like the Warren Buffett and the George Soros and the big players in the market that create in billions. Imagine I come to the market and I see that, okay, we are on an uptrend, right? I see that we're on an uptrend and I know how the algo behaves, right? I see because we are in an uptrend, we had buyers here, there were buyers here, there were buyers at this point, there were buyers at this point, there were buyers at this point, all of them putting their stop loss just below, hoping that the market will continue moving upward. As a big player, knowing how the algo will first of all hunt all those people as liquidity to engineer for the big players and the market makers to take price up. So that's the reason why, I don't know if you have been trading, maybe you have been demonstrating, you find out that, I know that price is going to go up. I put myself, price came down, it took me out, it hit my stop loss, but it still went to my direction, and you are so high and you're so angry. This is the reason why, because you are liquidity in the market, because these points are obvious points for the algorithm to see that money is resting there, because the algorithm is trained, is programmed. The algorithm is programmed to do two things. Number one thing the algorithm is programmed to do is to what? Balance price. I will explain. Number two is to what? Seek liquidity, right? That's the the market operates on these two basic principles. I can still say that the market operates on one principle, but I've not taught you that. That's why I don't want to mention it. The one principle is seeking liquidity. Market always seeks liquidity. We have the concept of internal liquidity and external liquidity, which I don't want to put so much in this class. In the next class, because we are looking at liquidity concepts, so we are going to look into that in advanced market structure, right? So I'm going to have a class dedicated strictly for liquidity, but I'm just using liquidity to explain advanced market structure. So you see, in this case, this is what the market will do. It will always hunt this liquidity before going up, so it doesn't move in straight line. So the first, now, this is another rule I'm giving you, another rule. The first higher low for a bullish movement, the first higher low created, right? The first higher low created, the last higher low is most times inducement or liquidity. It's most times inducement or liquidity, right? So that's why when you go in price, this is the concept of advanced market structure. So price will always move like this. It will always move, right? Move like this, then come down to hunt the liquidity before continuing in the upward direction. I think I can close here. Do we have questions? Let me give them for questions. I don't want to overload you. If you leave me, I can go for 2 hours straight. So let's take questions. Then in our next class, we'll get deeper. Like I say, I want you to understand, because when we start getting deeper, it will be difficult to understand. So briefly, now the bearish movement is just the same thing. So it's the inverse. So if you invert it, the same thing. The same thing I explained now is the bearish. So for the bearish movement, let me just say it for this class so it's in the video so you can watch it. For the bearish movement, the same rules apply. Now the rule will be inverted, stating that the important candle was the candle that took out the previous candle's low, right? That's the important candle. And the subsequent candle must trade above the important candle's high. That's the rule for the bearish movement. The subsequent candle must trade above the important candles high and close below the important candles low. That's the rule. So inverse it. If you can just go and watch this part to understand, I'll take the rule again. The subsequent for bearish movement downtrend, the rule still applies. It means that our important candle now becomes the candle that took out the previous candle's low and close below. Now that important candle, the next subsequent candle must trade above its high, and the next candles now close below its low. So if you inverse the same rule, it applies. So I just thought to say that before we ask our question, I will call it a day today. So do you have questions? Let's get your questions. You can raise your hands, ask your question. Please, let's feel free to ask our questions. I want to be sure you understand. Okay. So you can ask your questions even from the first class, right? From the first class. Jeremiah, you can unmute your, even from the first class, higher, lows, just ask. Let's just get questions. In the next 10 minutes, I will call it the day.
Okay, so I wanted to ask, at that liquidity point, what do the big players do to, you know, that they come out to buy out at that point? I didn't really understand what
Yeah,
happened. They're targeting that point. Is that so they will buy out these persons that have fallen victim?
yes, you're right. Now, what they do is they are buying out that point, right? Because a lot of money is resting there. See,
Okay.
the way the market operates is that there must be a matching order. For you to be able to buy in the market, that means there must be a matching seller to sell for you, right?
Okay.
Do you get the point? So
Yes,
those
sir.
orders, those stop losses at those points are the matching sell order, right? For the big players to buy, because they know that the algos will always go in direction of liquidity to seek liquidity, right? So they position themselves to buy all out those orders. So they buy out your stop losses, and it's what is called stop hunt or
Okay.
liquidity raid.
Okay, so the difference between the activity between both of us. Okay, take it that I'm a part of the losers. It means
Yes,
for me, I put out my stock to trade. Why them they come to buy what I've lost and add to their stock?
exactly.
Okay, then they will
Yes.
also sell later. They will turn to sell later.
They'll sell later, yes. They'll sell later.
Okay, okay.
You,
But the
you get the
the
point?
yes, the $200 points now helps me lose not more than $200.
Yes.
Is there no way I can keep myself not to lose at all?
Sorry to bust your bubble, but you cannot keep yourself from not to. You must lose. It's like a business, normal business. You must lose in the marketplace. But what makes you a profitable, consistently profitable trader is that your wins are more than your losses,
Oh, okay, sir. Okay,
right?
sir. Yes, sir.
Yes. So that's why I'm teaching you this concept. These are more precise concepts that will reduce your losses. These are not retail concepts, right? This is the way the big banks and the hedge funds and the institutions they trade. This is how they read price action.
Okay. If I may ask, uh, this question may sound wrong, but it's because I missed the last class. Okay. So when
No
the
problem.
trends are going up, um, okay, or when they buy from this liquidity point, when are they going to sell out?
Okay. Now I'll tell you when they are going to sell out. Now, do you know there are concepts that retail traders trade with, right? They call like
Okay.
support and resistance, right? So
Okay.
now there's how some people that use indicators, there are some indicators called oscillators like RSI, relative strength index. Like that indicator will tell you that people have bought. Let's take for instance this point. People have bought to this, let me delete this. People have bought to this particular point here. Wait, let me create a new one. Okay, people are buying higher, right? Let's say they are buying, sorry, they are buying higher, buying higher. So at a particular point, if you don't understand the institutional price action reading or the algo, normal players, retail players will say, it's overbought. Let's start selling. It has reached a point of resistance. It's time to sell. Do you understand?
Okay.
So now they start selling, right? Because they
Yes.
start selling, the algo will move down as if it wants to do. The institutions know. Now, this is the point where the institutions will come out and still use them and sell those their orders, those their buy orders at this point by taking out these people that have sold before they now sell to take
Wow.
out the other people. So do you get it? Do you understand the concept?
Yes. Yes.
So at
So
every time the price is seeking liquidity, seeking because retail traders are more, you have a lot of retail traders losing money in the marketplace, right?
yes, sir.
So they don't understand the price, so they're just trading based on. We have the people that will just learn small and just go and fund account and just want to trade. The money is all that. Those are liquidity pools that the algo funds and the institutions play with.
Wow.
Yeah. Okay. So any other question? I hope that answers your question.
Yes, sir. It does. Thank you so much.
Okay. One more question. We'll call it a day. I think 1 hour now. Or two
all right,
more
I have a
questions.
question.
So decide. Okay, let me hear you.
All right, so during trading, do you just trade on one time frame or do you switch time frames? Like, let's say you start trading on um like a 5 minute or 15 minutes time frame, and you set your stop loss already. Do you get like switch or change time frames, or you just trade on one particular time frame?
Okay. Okay. It depends, right? It depends, right? What I'm doing, I'm taking you through all the concepts, right? So in this model, I think one of the before our last class, I'm going to take us on a model where I teach you my strategy, how I approach the market, right? So there's a way you use multiple time frames to analyze, right? And we know in analysis, when we get to that, but let me just say it in passing. In analysis, the higher time frames always takes precedence over the lower time frame. Why? Because the big boys don't have time to sit on the system all day, so they trade off the higher time frames, right? Which are the from 4 hour, daily, weekly, monthly. So basically you get use those time frames to get the direction of the market flow. Then you can use your smaller time frame for entries. But some people, when you understand price action is fractal, right? What it means that the same thing happen on one time frame is the same thing happen on another time frame. So you can even be such a trader that you don't even move. I know a few traders that are very profitable. They don't even go higher than 15 minutes. They don't even look anything at higher time frame. They just look at what price action is presenting on the 15 minutes time frame and they trade off it. So it depends on you. But I will always advise that always get your direction, the direction of the market from the higher time frames. Then even if you want to trade the lower time frames, you can go lower. And it also varies based on your trading style, right? You know that there's the scalper, there's the swing trader, and there's the position trader. The scalper being the person that trades, like takes positions, closes, take position, closes, small profit and closes, right? So scalpers also leads to day traders, people that trade and close all their trades before the end of the day. Those are day traders, scalpers to day traders, right? So they can trade and hold their trade and close before the market closes. Those are scalpers and day traders. Then we have the swing traders that can hold for multiple days, 2 days, 3 days, 1 week, 2 weeks. Then we have these position traders that can hold for months. Most of these big players are position traders, right? So that's why you discover that the higher time frames will always show the direction because there's more. The algo we pump liquidity in the direction of the big players, right? Does that answer your question,
Yes,
Maranatha?
I do. Thank you, sir.
Okay, you're welcome. Okay, any other question? Okay. Okay, Jeremiah, this is your last question. After your question, we'll call it a day.
Sorry. I'll just make it brief. This
Okay.
answer you gave to the last person, this information about types of traders and all of that, is it going to be one of our classes as we proceed?
Yes. Now,
Okay, so
why it's not part of a model, because the truth is it's not important. Because when you
okay,
start trading, but you know based on your personality, you know the kind of
okay,
trader you are, right? When we
okay,
start, that's why when we go through, it's not too important. It's not important. That's the truth. Because I'm teaching you how to read price. From teaching you how to read price, by the time I'm done with teaching you how to read price, then I will show you how my personal approach based on this concept, using all the concept I've taught you, how I approach the market every day based on my style, right? Personally, for me, I'm a day trader, right? Because I don't hold position beyond the day. I don't hold position beyond the day. So I'm a day trader. But when this same concept, if you discover that, okay, maybe I'm doing trading for part-time right now, I have a 9 to 5, so I can just tweak it such that I'll be a swing trader. I take my position, I hold it for a while, do my job. When I come back, I see what price is. It's left for you. So it's not that important. That's why it's not a model. That's just simply it. Scalper, like I explained, they just they go in and out, take small profits, right? Mainly they stay below 30 minutes time frame. Scalpers stay below 30 minutes, so from 30 minutes downward. Then from swing traders from 15 minutes upward. Then position traders are from 4 hour daily, people that take position from the daily. You have to have a lot of money. When we go into the risk management class, you understand why you need to have a lot of capital for you to be able to be trading off the daily time frame.
okay, sir. Thank you so much, sir.
You're welcome. Okay, guys, we've come to the end of today's class. So next class, we are going to dig deeper into advanced market structure. For want of time, next class, I think we'll go into chart examples, right? We'll go into chart examples on basic market structure and advanced market structure. Then subsequent class will now treat liquidity in full, right? Thank you guys so much for joining the class. Please, let's for assignment, please just go and rewatch the videos again and understand it. I've explained better, right? So understand, now you can mark your basic market structure, map it better. So you know the rules. So go at your chart, just go to the chart, go to any of the assets and look at it and use the rule. It could be 1 minute, it could be 3 minutes, any time frame. Just use the rule and mark your higher highs and higher lows, and you can just drop them in the group during the course of the week before our next class on Thursday. So thank you guys so much. I hope this class was insightful, and I hope you found value. See you in the next class on Thursday. Bye.
Thank you, sir.